All right, want to decode those market mysteries?
Oh,
You're diving deep into Howard Marks' book, Mastering the Market Cycle,
okay.
to really help us and you get a grip on those market swings, those ebbs and flows.
Right.
It's like he's giving us this compass to navigate all those peaks and valleys, financially.
Yeah, that's a great way to put it.
Right.
Marx, he really stresses how, practically everything in the market, it moves in these cycles. Economic growth, even just investor sentiment, you name it, it's cyclical.
Makes sense.
It's like seasons changing. You go from all that optimism and growth of a bull market, like a sunny summer,
Okay.
to the pessimism and all that contraction of a bear market. Like, think winter.
So if we understand those seasons, we can be prepared. Right?
Exactly.
Like knowing when to plant, when to harvest.
Exactly. Yeah.
Okay.
Well, each market cycle, it's unique in its specifics, but the underlying themes and how investors behave, they tend to repeat. So recognizing those patterns, it can be a huge advantage. Like, a seasoned traveler, they just kind of know what to expect around each bend in the road.
But it's not as simple as just looking at charts and graphs, right?
Oh, no.
There's that human element.
Absolutely.
Those emotions that Marx talks about.
Yeah, investor psychology.
Yeah.
It's a huge driver of these cycles. Think of it like a pendulum swinging between, fear and greed.
Okay.
When the market's down, fear just takes over. People become risk averse,
Yeah.
They'll sell even fantastic companies
Right.
at bargain prices.
It reminds me of after those corporate scandals back in 2002,
Yeah.
investors wouldn't touch those companies' bonds.
Right.
Even though they were practically giving them away.
Oh, classic example.
Right.
And on the flip side, when things are booming, greed kicks in.
Yeah.
People get overly optimistic, throwing caution to the wind,
Right.
paying any price for assets.
Yeah, like during the dot-com bubble.
Remember that.
Yeah.
People thought, the internet's going to change everything.
Right.
No price was too high for these tech stocks.
Mm-hmm.
We all know how that story ended.
Ouch. Yeah. That irrational exuberance can lead to some serious financial hangovers, huh?
Oh, yeah.
So we got this pendulum
Yep.
swinging between fear and greed.
Right.
What else is kind of amplifying those market swings?
Well, you can't talk about market cycles without talking about the credit cycle.
Okay.
And think of it as like lighter fluid
Yeah.
on those emotional flames of fear and greed.
Adding fuel to the fire.
Yeah.
So when credit is flowing freely.
It can lead to explosive booms, but it, often comes with reckless lending practices,
Right.
Creating these bubbles ready to burst. Think of the subprime mortgage crisis.
Oh, yeah.
Easy credit led to lax lending.
Right.
And we saw this, wave of defaults that few anticipated.
It's a stark reminder what goes up too fast can come crashing down just as quickly.
Oh, absolutely.
Yeah, and when that credit dries up.
It's like hitting the brakes hard.
Yeah.
Creates tough times, even for solid companies.
So how do we master these cycles?
Yeah.
Does Marx have a crystal ball?
He'd probably be the first to tell you nobody can predict the future consistently.
Right.
It's not about predicting the exact peak or the exact valley.
Okay.
It's about understanding where we are within the cycle.
Okay.
And adapting our strategy.
All right.
So, it's about recognizing those signs of fear or greed and, adjusting our course accordingly.
So like that seasoned traveler, we're looking for landmarks to guide us, not trying to predict every pothole in the road.
Exactly.
Wow.
Are we in a period of widespread fear or excessive greed?
Right.
Are lenders, are they being cautious or are they throwing money around? Asking these questions, it helped us get a read on the market climate, make smarter choices.
So if we sense that fear is driving the market,
Yeah.
might be a time to be more aggressive, seek out bargains
Right.
that others are too scared to touch.
Yeah.
And when greed is in the air,
That's when we should be more defensive,
okay,
more selective, maybe even take some profits off the table.
got it. So mastering the market cycle is less about timing the market perfectly
Right.
and more about recognizing the signs
Yeah.
and adapting our approach.
Right. To see how these principles play out in the real world, let's look at real estate,
Okay,
which is a great example of a market driven by cycles.
perfect. I think we all know someone who got caught up in the housing bubble not too long ago.
Absolutely. But let's go back even further.
Okay.
To the 1980s.
Okay.
There was this massive housing boom back then,
Yeah.
fueled by, you guessed it, easy credit.
Of course.
Remember the saying, if you build it, they will come.
Oh, yeah.
Well, lenders were basically handing out cash to developers, encouraging them to build.
They built it, but did they come?
Not really. All that building, it led to this huge surplus of properties.
Right.
When demand didn't catch up, prices crashed.
Okay.
It's a classic example of how easy credit can inflate a bubble.
Makes sense.
And when that bubble pops, it can have a big impact.
Okay, so those booms can turn to busts pretty quickly if we're not careful.
Absolutely.
But doesn't that also mean there are opportunities in those downturns
Oh, yeah.
for those brave enough to dive in when everyone else is panicking?
Absolutely. That's when those who understand the cyclical nature of the market, they can really shine.
Okay.
Howard Marks and his team, they're known for being contrarian investors,
What does that mean?
which means they're willing to go against the crowd.
Got it.
And during that real estate crash in the early 1990s, they were able to buy properties at incredibly low prices.
Sounds like they were picking up some serious bargains.
They were. And those investments ended up being some of their most profitable.
Okay.
It's a great example of how going against the grain when you understand the cycle can really pay off.
So we got this pendulum swinging between fear and greed, credit cycle fueling the fire, the importance of recognizing where we are in the cycle.
Right.
But how do we actually figure out where we are?
That's the question.
What are some of those clues we should be looking for?
That's where things get a little more complex.
Okay.
There's no magic formula. No two cycles are exactly alike. But there are some key indicators we can watch for.
Okay, so no easy answers, but there are clues.
Precisely.
Okay.
One important signal is the availability of credit.
Okay.
You know, when lenders, they're eager to lend. When terms are loose and they're not being too picky about who they lend to,
Okay.
that's a sign that we might be in the later stages of a boom.
So those too good to be true loan offers might actually be a warning sign, not a gift.
They could be. Another thing to watch is investor behavior.
Okay.
When people are overly optimistic, chasing the latest hot trends and willing to pay any price for an asset,
Okay.
that's another sign we might be nearing a peak.
It's like when everyone's bragging about their market wins and suddenly, you know, your taxi driver is giving you stock tips.
Exactly. That's usually a sign that things are getting a little frothy. And conversely, when everyone is doom and gloom,
Yeah.
convinced the market's going to crash, that might actually be a good time to start looking for opportunities.
Ah, so it's that classic be fearful when others are greedy and greedy when others are fearful philosophy.
Exactly.
But it takes courage to go against the crowd, doesn't it?
It does, but understanding the market cycle can give you the confidence to make those contrarian moves.
It sounds like mastering the market cycle is as much an art as it is a science.
Yeah,
There's a lot of judgment involved, a lot of reading between the lines, and a healthy dose of self-awareness.
you got it. And remember, even though we can't predict the future perfectly, we can control how we reassect to it.
So being prepared, being adaptable, and having the right mindset are just as important as knowing the technical ins and outs of the market.
Absolutely. And on that note, let's explore some specific examples of how these market cycles play out in different parts of the economy.
Okay.
We can delve into various industries and asset classes to see how these cycles have impacted them.
Sounds good to me. Let's get specific.
Let's talk about distressed debt,
Okay.
an area where understanding the credit cycle can give you a real edge.
Okay.
Distressed debt is basically the debt of companies that are performing so poorly that they've either defaulted on their debt
Okay.
or are on the verge of doing so.
So we're talking companies in hot water,
Yes,
maybe even facing bankruptcy.
potentially.
Sounds risky.
It can be, but that's also where the potential for big rewards lie.
Okay.
You know, when companies are struggling, their debt is often traded at a significant discount
Okay.
because investors worry they won't get their money back.
So it's like those clearance sales where you're hoping you can find a hidden gem
Yeah.
among the discounted items.
That's a good analogy.
Okay.
But unlike that discounted sweater, distressed debt can actually offer a chance for profit,
Okay.
even if the company doesn't fully recover.
Okay, so how does that work?
Yeah.
How can you profit from a company that's not doing well?
Distressed debt investors are essentially betting on one of two outcomes.
Okay.
The company turns things around, starts paying its debts again,
Uh,
or the company goes through restructuring or bankruptcy proceedings.
it's like a high-stakes poker game
You could say that.
where you're betting on the company's ability to either recover
Right.
or be broken up and sold off.
You got it.
Okay.
Distressed debt investors, they often have a say in how the company is restructured
Okay.
and can use their position to negotiate a favorable outcome.
So it's not as simple as just buying low and selling high.
Right.
You need to understand the legal and financial complexities of these distressed companies.
You need to know what you're doing.
Yeah, and the bankruptcy process.
Exactly. And that's why understanding the credit cycle is so crucial.
Okay.
Those downturns, when credit dries up, companies struggle, those are prime time
Okay.
for distressed debt opportunities.
It's like finding those rare flowers that only bloom after a forest fire.
That's a great way to put it.
Right.
A really vivid example of the distressed debt cycle in action played out during the 2008 financial crisis.
The one fueled by those risky subprime mortgages we talked about over
Yes,
there?
that crisis was fueled by a massive buildup of debt,
Okay.
much of it tied to those subprime mortgages.
Right.
When the housing bubble burst,
Yeah.
it triggered a wave of defaults,
Right.
pushing tons of companies to the brink.
So that created a massive opportunity for distressed debt investors
It did.
who were willing to step in at that point.
Absolutely.
But-
Fear and panic gripped the markets, and many investors were desperate to sell their debt holdings,
Okay.
often at fire sale prices.
Like a Black Friday sale for distressed debt.
You could say that.
Wow.
It was a time of extreme uncertainty, but also a time of tremendous opportunity for those with the expertise and the courage to navigate those turbulent waters.
So distressed debt is one example of how understanding cycles
Yeah.
can give you an advantage.
Right.
Now, what about real estate?
Real estate is a perfect example.
Yeah, it's something most people can relate to, right?
Oh, yeah.
Buying a house or
Absolutely.
renting an apartment.
One of the fascinating things about the real estate cycle is how long it takes to build new properties.
What do you mean by that?
Well, building something new, whether it's a house,
Okay.
an apartment complex, a shopping mall,
Uh.
takes time from acquiring the land, getting permits,
Right.
securing financing, actually constructing the building. It can be a multi-year process, even decades for major projects.
So the market conditions could completely change between the time a developer breaks ground
Absolutely.
and when the project is actually finished.
You got it.
Wow.
Imagine a developer decides to build a luxury condo tower during a real estate boom.
Okay.
They secure financing, they hire architects, they begin construction. But by the time the building is finished,
Right.
the market might have cooled down
Uh-oh.
and they're left trying to sell expensive condos
Right.
in a buyer's market.
Ouch. That sounds like a real estate nightmare.
It can be.
Yeah.
And it highlights how important it is to understand where we are in the real estate cycle
Okay.
before making major investment decisions.
So if you're thinking about buying a house or investing in a rental property,
Yeah.
you can't just look at current prices.
Right.
You need to look at the bigger picture.
Exactly. Factors like building permits,
Okay.
new construction activity, population growth, job creation can give you clues about the direction the market might be heading.
It's like trying to predict the weather.
Yeah.
You can't just look out the window.
Right.
You need to look at those larger patterns and trends.
That's a great analogy. Just like with weather forecasting,
Right.
there's always some uncertainty.
Yeah.
But by paying attention to the cycles and the signals,
Uh-huh.
you can increase your odds of making smarter choices.
So it's all about awareness
Right.
and informed decision making.
Absolutely.
Speaking of awareness, we've talked a lot about the fear and greed pendulum
Yeah.
driving the markets. But is there also a popularity pendulum at play?
That's a great point. In the world of investing,
Okay.
popularity can be a double-edged sword. When an asset class or investment strategy becomes the hot new thing,
Right.
it often drives prices up, leading to lower returns down the road.
That's like that trendy new restaurant that
Yeah.
everyone's raving about. It might be good,
Yeah,
but you'll likely have a long wait and pay a premium.
exactly. In investing,
Right.
just like with restaurants, the crowds eventually move on
To the next big
to the next big thing, and those who jumped in late
Yeah.
are often left disappointed.
So how do we avoid getting caught up in the hype and stay ahead of the curve?
There's no foolproof method,
Okay.
but here are a few things to keep in mind.
Okay.
First, be aware of the trends and shifts in investor sentiment.
Mm-hmm.
Pay attention to what everyone's talking about,
Okay.
but don't get swept up in the hype.
So be informed, but skeptical.
Exactly.
Don't just follow the herd.
Exactly.
That is-
Second, be willing to be a contrarian.
Okay.
This doesn't mean blindly betting against the crowd,
Right.
but it does mean being open to alternative viewpoints
Okay.
and looking for opportunities that others might be overlooking.
So think for yourself, do your homework,
Yes,
and don't be afraid to take a different path.
right. And perhaps most importantly,
Okay.
keep a long-term perspective.
Mm-hmm.
Market cycles come and go. But the fundamentals of sound investing remain constant.
So don't get distracted by the short-term noise.
Right.
Focus on the long game.
Absolutely.
And remember that these cycles are always at play. Always. Whether we see them or not.
Well put. To see how this popularity pendulum swings,
Okay.
let's take a quick trip back to the late 1990s.
Back to the dot-com bubble.
Yes, but this time, let's focus on how that bubble played out
Okay.
with technology stocks.
Okay.
Back then, everyone was convinced the internet would change the world.
And they were right about that.
Absolutely.
Yeah.
But that optimism got out of control. Investors were pouring money into any company that
Yeah.
even mentioned the internet, regardless of their actual business model or
Right.
profitability.
Sounds a lot like the crypto craze a few years back.
There are definitely some parallels there.
Yeah.
And as we saw, when those bubbles burst,
Yeah.
it can get pretty ugly.
Right.
But for those who were paying attention to the signs, who saw the excess and the irrational exuberance,
Mm-hmm.
there was a chance to get out before the crash.
So understanding the cycles and recognizing when things are getting a little too popular
Yes,
can be key to avoiding those big losses.
absolutely.
It's about keeping a level head when everyone else is losing theirs.
It is. And on that note,
Okay.
let's talk about the Nifty 50.
Nifty 50. Sounds like a 1950s rock band.
It kind of was a rock band
Okay.
in the investing world.
Right.
The Nifty 50 were a group of blue chip stocks
Okay.
that were considered the cream of the crop
Okay.
back in the 1960s and early 1970s.
So these were the superstars, the companies that everyone wanted to own.
Exactly. Companies like IBM,
Mm-hmm.
Xerox, Coca-Cola, McDonald's,
Big names.
they were viewed as unstoppable growth machines,
Okay.
and investors were willing to pay sky-high prices for their shares.
But if they were such great companies, what went wrong?
Well, as we've seen time and again,
Yeah.
even great companies can become overpriced. And when investor sentiment shifted, when those growth expectations cooled,
Okay.
the Nifty 50 stocks came crashing down to earth.
So no matter how good a company is, it's crucial to remember that price matters
It does.
and that price is heavily influenced by investor psychology
Absolutely.
and those market cycles we've been discussing.
Exactly. And that brings us to a crucial point.
So-
The role of companies themselves
Okay.
in these cycles.
So we've talked about investor psychology, the credit cycle, the popularity pendulum. Now we're adding companies to the mix.
We are.
It sounds like there are a lot of moving pieces.
There are, but that's what makes markets so dynamic
Yeah.
and intriguing.
Right.
It's important to remember that companies aren't just passive players in these cycles.
Okay.
Their decisions, their strategies, their performance can actually shape
Mm.
the cycles themselves.
So it's not just external forces pushing companies around.
Right.
They're actually influencing the game.
Precisely. Think of it as a dance. The market sets the rhythm,
Oh,
but the companies are the dancers.
I like that.
And sometimes those dancers can lead,
Uh-huh.
they can improvise, and they can even change the tempo of the music.
That's a fantastic analogy.
So,
So how can a company's actions actually impact the market cycle?
yeah,
Give me an example.
let's look at Xerox.
Okay.
One of those nifty 50 companies we talked about.
The copier company.
Yes.
I thought they were a huge success story.
they were for a while.
Okay.
In the 1960s and early 1970s,
Mhm.
Xerox was the undisputed king
Okay.
of the copier market,
Ever.
enjoying a near monopoly, incredible profits,
Wow.
and a soaring stock price.
It sounds like they were at the top of their game.
They were.
What happened?
Well, their very success contained the seeds of their eventual downfall.
Okay.
Because Xerox was so dominant
Right.
and their profit margins so high, they attracted.
A lot of competition.
It's like that saying, success breeds competition. It's exact. Everyone wants a piece of a profitable pie.
Right. As competitors entered the market, they undercut Xerox's prices
Okay.
and offered new alternatives.
Right.
This chipped away at Xerox's market share and profit margins, ultimately leading to a decline in their stock price.
So their initial success created a wave of competition
It did.
that eventually eroded their dominance.
Exactly. It's a classic example of how a company's actions can have ripple effects throughout the market,
Yeah.
even influencing the direction of a cycle.
It's like a constant push and pull,
Yeah.
this dynamic interplay between companies, investors, and those broader market forces.
Absolutely.
It's like a game of chess where the pieces are always moving and the board is constantly changing.
That's a great way to think about it.
Right?
And just like in chess, understanding the patterns,
Right.
anticipating those moves, thinking a few steps ahead
Right.
can be the key to success. So it's like we need to sharpen our chess skills if we want to master this market cycle game.
We do.
Speaking of which, how do we spot those turning points?
Yeah.
Those moments when the pendulum swings in the other direction.
Yeah. That's one of the trickiest parts.
Yeah.
Recognizing those turning points, those moments when the market
Right.
shifts from bull to bear or vice versa.
Ah, yes, the elusive art of market timing.
Right.
Some say trying to time the market is a fool's errand.
Yeah.
What do you think?
There's definitely some truth to that.
Okay.
It's incredibly difficult to pinpoint those exact peaks and troughs consistently. Even the most seasoned investors get it wrong sometimes.
So if we can't rely on crystal balls,
Right.
how should we approach this?
Yeah.
What are some signs that the market might be about to turn?
Well, Howard Marks, he talks about watching for excesses or aberrations.
Okay.
Those extremes we've been discussing, they're like red flags that things are getting out of hand.
Okay, so it's like those temperature gauges. When the needle creeps into the red zone,
Right.
it's time to proceed with caution.
Yeah.
What would that look like in the market?
On the upside, signs of excess might include incredibly easy credit, where lenders are practically begging people to borrow money.
Okay.
You might see sky-high valuations where assets are trading at prices that seem completely detached from reality.
Right.
And there's often this widespread euphoria
Yeah.
where everyone's convinced the good times will last forever.
It's like that feeling at a party when the music's pumping, everyone's having a blast.
Yeah.
And you just know someone's about to spill red wine on the white rug.
Yeah.
It's fun until it's not.
Right. Perfect analogy.
Right.
Now, on the downside,
Right.
you might see things like sudden freeze in credit markets,
Okay.
where even solid companies are struggling to get funding. Asset prices, they plummet to like bargain basement levels.
Right.
And there's often this feeling of just pervasive pessimism
Yeah.
where everyone thinks the world is ending.
So when things seem too good to be true,
Yeah,
they probably are.
they probably are.
And when things seem utterly hopeless, there might actually be hidden opportunities
Right.
for those who can stomach the risk.
That's the essence of contrarian investing. It's not easy to maintain that mindset when everyone else is caught up in the emotion of the moment.
Right.
But that's also why it can be so rewarding.
It sounds like mastering the market cycle requires us to master our own emotions
Absolutely.
as much as it does understanding external forces.
Very true. Now let's shift gears slightly
Okay.
and talk about another important concept from Howard Marks.
Okay.
We can't eliminate risk altogether.
Yeah.
We can only strive to manage it.
It sounds like a pretty fundamental investing principle. Isn't it tempting to think we can have high returns without taking on much risk?
It is tempting,
Yeah.
especially when markets are soaring. It's easy to fall into that trap.
Right.
But in investing, like in life,
Yeah.
there's no such thing as a free lunch.
Right.
Risk and return are always intertwined.
It's like wanting to have our cake and eat it too.
Exactly.
Right.
The potential for higher returns always comes with a higher level of risk.
Okay.
Understanding market cycles can help us manage that delicate balance.
Okay.
When you have a sense of where we are in the cycle,
Right.
you can adjust your risk accordingly.
So when markets are high
Yeah,
and risk is high, it might be time to dial back the risk in our portfolios.
precisely. You might want to reduce your exposure to more speculative assets, increase your cash position, and maybe even consider some defensive strategies like hedging.
And when markets are down and fear is high.
That might be a good time. to cautiously consider taking on a bit more risk,
Okay.
recognizing that, downturns can present fantastic opportunities for those who have done their homework
Right.
and are prepared to ride out the volatility.
It's all about being adaptable, like
Right.
adjusting your sails to navigate the changing winds.
Perfectly put.
Right.
It's about having a flexible investment strategy that can adapt to the ever-changing market conditions.
Okay, so we've covered a lot of ground today,
We have.
from the psychology of investors
Yeah.
to the influence of credit cycles to recognizing those crucial turning points.
Yeah.
As we wrap up, I'd love to hear your take on what it truly means to master
Oh, that's a good question.
the market cycle.
Yeah, it's obviously not a simple answer.
Right.
But what are your thoughts?
Well, it's definitely not a simple answer, but for me, I think it comes down to a few key things. First, you need a deep understanding of how cycles work, both in theory and in practice.
So, doing your research.
Right.
Studying market history, learning from those who came before us.
Exactly.
Yeah.
Second, being able to recognize where we are within a given cycle,
Yep.
being able to read those market signals
Yeah.
and anticipate potential shifts.
Like a seasoned meteorologist who can read the clouds,
Right, exactly.
forecast the weather patterns.
Great analogy.
Yeah.
And third, and perhaps most challenging,
Oh, yeah.
is having the discipline and the emotional resilience
It's tough.
to stick to your strategy,
Yeah.
even when the market is testing your patience and your nerves.
You got it.
So don't get caught up in the hype or the panic.
Right.
Stay focused on those long-term goals.
Exactly. Mastering the market cycle isn't a destination. It's a continuous journey of learning, adapting, and refining your approach.
Right.
Even the most seasoned investors are constantly working on this.
Well said. So for those of us who are just starting out on this journey,
Yeah.
what's the most important thing to keep in mind?
I think the most important thing is simply to be aware that cycles exist,
Okay.
to understand what drives them, and to be on the lookout
Yeah.
for those excesses and aberrations
Right.
that can signal a shift in the market.
So stay informed,
Yes.
stay adaptable,
Yes.
and never stop learning.
Precisely. The market cycle is always at play,
Yeah.
even when it's not obvious. The more we understand about it,
Right.
the better equipped we'll be to navigate those inevitable ups and downs and reach our financial goals.
Great advice. I think we've given our listeners a lot to ponder today.
We have.
Understanding these market cycles is definitely not a simple task,
No, yeah.
but it's essential for anyone who wants to navigate the world of investing successfully.
Absolutely. As Howard Marks reminds us,
Yeah.
the more we understand about cycles, the better prepared we'll be to make informed decisions, manage risk effectively, and ultimately master the market.
And on that note, we'll wrap up our deep dive
Okay.
into mastering the market cycle.
Sounds good.
Until next time, happy investing.